Hi, we're TP Consulting, and we're here to analyze another case of Blades PLC. This time we're going to talk about derivatives and hedging risks. So we're going to go ahead and present our outline. We're going to talk about three topics: evaluating call options, hedging risks, and futures. And to just jump right ahead, in the case we're presented with three call options, and we have to evaluate which one's the most attractive for Blades PLC. So to do this, basically, we analyze the price of the three different call options, and how we do this is basically just by looking at how much Blades PLC would pay for commission, and how much they would pay at the settling date of the call option. And so in the table we have the first, the second, and the third option. And as we can see, for the first option, we have a commission of 556, which would be about 1.85% of the spot price of the yen. And so when we assume that the spot price in the transaction would remain the same, and this is just to sort of show the impact or sort of how the cost structure is going to be. It's gonna impact the transaction. We basically just add up how much the differential between the spot price and the call option price. And so when we look at the difference between these two, it's 30,000 against 31,500. We're gonna look at a loss of 2,056, and this is obviously adding the commission. And so when we do this exercise for the three options, we're gonna see that we actually have that it's the third option that it's the most expensive one. So we would definitely go for one of the other two options. They're very close, so it'll give us a sort of a higher margin in the long run. So with this said, we're gonna look also at how we're supposed to, or the considerations we need to take when hedging risk. And of course we need to evaluate the cost benefit of each option. And we're looking at two scenarios here. We're looking at hedging and not hedging. And so when we're considering whether we're going to hedge or not hedge, we have to look at, first of all, what's the characteristics of the market. We need to understand whether we're dealing with a very volatile currency, or whether we expect some sort of event to affect the behavior of the currency. And so based on that, we need to assess the cost of hedging it against the potential loss that we would expect in the future, given our expectations, of course. And one of the things that we need to consider in this case is that we know that the Japanese yen has been quite volatile. So perhaps it being the best interest of Blades PLC to hedge the currency, given that if they were to go into a call option, they would have flexibility, and of course this flexibility would come at a cost. But still, when dealing with a very sort of uncertain currency, it is important to sort of look into the possibilities of hedging, given the possibilities of the company. And so when hedging, we basically have two scenarios. One is the buyer and one is the seller side. And of course, depending on what role you have on the transaction, you'll have different expectations. And as such, when you're a buyer, you would actually expect the price to increase in the long run, and if you're a seller, you would expect the price to decrease. And so depending on the behavior of the exchange rate, and depending on how the conditions of the market, whether they go sort of along the predictions or the forecast that you had taken into consideration before, then of course you would sort of decide on making the contract, delaying the contract, or trying to issue the contract as fast as you can. And this again depends on sort of like the company structure, the goals of the company, and the behavior of the currency in the market. So now Tori's gonna continue with the presentation, and she's gonna talk about optimal strategy.
Okay, so next we're asked what is the optimal strategy for Blades PLC, whether they should allow their position to be unhedged, whether they should take part in a futures contract, or whether they should purchase one of the options. We're first looking at the assumption that the future spot rate will be the same as the future contract rate. So looking at these three scenarios, if we assume that the future spot rate is indeed the same as the future contract rate, if we leave our position unhedged, we're basically going to just exchange the currency 2 months from now, and it's not really going to cost us that much. Similarly, if we look at the futures contract, once again, the price of the futures contract will be the lowest rate. So once again, we don't really have an opportunity cost there. However, with the options, since the strike price of both the options are above the current spot rate, even though we expect the spot rate to decrease, we'll just let both options expire under these assumptions, but we have to pay a premium to buy the option. So the options will expire. We won't really gain anything from those options, but we'll have paid in order to buy them. So in this case, the optimal strategy between remaining unhedged and buying the future contract are relatively equal, but if we remain unhedged, we have less of a transaction costs. So that is the course of action that we would take. On the next slide, we're going to talk about whether this assumption that if we remain unhedged will actually be the lowest cost alternative. And we'll also look at the options. As I mentioned before, both of the options are currently out of the money. So if the future spot rate equals the future contract rate, it's not really advantageous for us to buy either of these options if we consider that we know this for sure, which is of course an assumption that we don't know. However, looking at the exercise price and the option premium per yen, we can see that the price for buying the second option would be a little bit less, as the exchange rate would have to rise considerably for it to be in the money, whereas for option 1 it's a little bit more, as the exchange rate won't have to rise as much to be in the money. So option 1 is closer to being in the money, although you have to pay a higher premium for it. So as we're saying, the actual cost incurred will depend on the volatility and, so to say, on the chance of what's actually going to happen to the exchange rate, because while the future contract price incorporates the knowledge that the market currently has and the known information, the unknown information could result in the exchange rates acting contrary to what's been predicted. Let's take, for example, some natural disaster happens that's detrimental to Japan's economy or something. This is going to affect the exchange rate in a way that the market hasn't currently predicted. So in this way, the future spot rate could be different than the future contract rate. Now we're going to look at the volatility, and we're going to look at the payoff of the two options. As you can see, with the first option, when it's out of the money, make a net loss. up until slightly past when it's in the money, as you can see when it starts to rise. And with the second option, it's the same story. Even though the net loss is big, the option only starts to be in the money later. So depending on exactly how volatile the exchange rate is will depend on which option you would like to get. We'll now look at all 4 scenarios on the next slide. First we can see with the 45-degree line what happens if you remain unhedged as the exchange rate varies over 2 deviations of the current spot rate. The 45-degree line is if you remain unhedged. This means that as the exchange rate increases, the price of your 12.5 million yen will increase at a similar rate. If you see the flat line, you will see that the amount under the futures contract to purchase the 12.5 million yen will remain the same, no matter how much the exchange rate increases or decreases, since that's kind of locked in. And then you see your 2 options, which you can see the very slight difference between option 1 and option 2 due to the higher premium of option 1 because of the lower strike price than option 2. And then you can see where the price of the options level off once you're in the money and you're paying a specific fixed price even though the exchange rate's increasing. So which scenario to choose optimally depends on what actually happens to the exchange rate. You can't really know this, so we're looking at this with a little bit of hindsight. However, we can see that in the beginning, it's best to remain unhedged until the point where the exchange rate actually equals the future contract rate, and from there it's optimal to remain hedged, as these are the lines where you pay the least for getting your 12.5 million yen. So at no point does either option really be that beneficial to you in this scenario. So we would remain unhedged if we're expecting the exchange rate to depreciate just substantially. If it's still depreciating but not as much, we would go with the future contract. And we'd like to thank you for listening to our presentation, and as always, feel free to comment and ask any questions that you may have.